Hey everyone, Safi Russell here, founder and CEO of SDR Consulting Inc. Hope all is well with you. A little bit about myself. I've been in the industry 20 years and I'm a CPA and enrolled agent based in New York. And SDR is a virtual practice, so we do work with clients all over. We mostly work with business owners, especially those in the mental health profession, helping you resolve your concerns regarding tax and accounting so you can focus on your business and your patients or clients. So today I want to talk about retirement planning from a tax perspective. Now, I recommend that you connect with a financial advisor to go over all the specifications of the retirement plan rules and options for you specifically. We work with a couple of advisors that we can recommend. However, I want to talk more about the tax side of it and how that works and some of the limitations for tax year 2022. So when you're in business, it's your responsibility to save for retirement, unless you also do work and have a retirement plan at work. If you don't, you want to be prepared for the day where you're no longer running your business, right? And maybe you sell it and make a good profit there, but at some point you'll need some funds until the day you're gone. Okay. So, kind of morbid to think about it, but it's reality. So, how do you save for retirement? I'm going to discuss two different options relatively briefly. The first option is a SEP IRA. And a SEP IRA is one method that you can set up as a business owner, whether it be a sole proprietor or a single member LLC, or even if you own a company that you made an S selection for in your tax as an S Corp. You can have a SEP IRA. Limitation is 25% of your net profit or 25% of your wages if you have an S corp. And so if you're an S corp and you're not compliant, you're not paying yourself wages, guess what? You don't have anything to do to calculate 25% on. So just keep that in mind when setting up structures to make sure you're prepared for that. But let's say that you are an LLC owner, you're the only member, your Schedule C shows a profit at the bottom. That profit at the bottom, for the most part, 25% of that is what you'll be able to deduct. There's some other calculations that go into it. It comes out to roughly 20%, but for simplicity, we're going to keep it at 25. There is a maximum amount you can contribute. So the max for 2022 is 61,000. And so if you have enough profit to be able to make the maximum payment, great. What that means is you're not getting a credit for 61,000. It's not a dollar for dollar deduction. You get to reduce your taxable income by 61,000. So let's say your taxable income bracket is 22%. You can roughly say that 22% of the 61,000 you're going to contribute is what you'll save in taxes. Okay, so if you're going to contribute, let's say 60,000, then you go ahead and take 22% of that number, right? I won't do math in my head. so, so that's how the contribution works. Similar process for a solo 401k. A solo 401k is a 401k for individuals, and same limitations apply, 25% of your net adjusted self-employment income. And the max for 2022 is actually 61,000 as well. The only difference with a solo 401k is that if you, for example, have an S corporation where you're an employee and the owner, you can have a profit sharing portion, and then you also have the employed tax deductible contribution. So through your paycheck as a W-2 employee, if you have an S corp, you can contribute $20,500 in 2022 pre-tax from your check. This means that you're paying less taxes during the year by putting into your 401k. So that 20,500 is the limit for 2022. Now the overall max of 61,000 means that the other portion, as long as you have enough profit, you can make a profit sharing contribution of 25% of your W-2 employment. Okay, so remember you're the owner and the employee. So as the employee, you can contribute 20,500. As the owner, you can do a profit sharing based on 25% of the wages you're paying yourself as an employee. Overall maximum is 61,000. All right. So hopefully those numbers didn't confuse you too much. I definitely recommend speaking with both a financial advisor and an accountant to confirm your eligibility to contribute to those type of plans. To confirm the amount that you can contribute. You don't want to over contribute because then you'll have a excess contribution, which has tax effects. So you want to make sure you're contributing the right amounts. The benefit of the SEP IRA is that you can actually set it up after the tax year has closed and still contribute for the previous year. So for example, there are people who just contributed September 15th and it counted towards 2021 and helped reduce their taxes. I had one client that had completely wiped out their tax liability because they had the cash flow to contribute the maximum amount. Okay, so it's a strategy. Great for retirement planning, also great for tax savings, but you do need to have cash flow because it's going to require you to put that money into the retirement plan and leave it there. All right. So hope that helps. And if you're not saving for retirement already, definitely want to. It's something you should consider, and you don't have to contribute those maximum amounts. That's just the limit. So you contribute whatever you can, and we'll see if it has some benefits for you depending on your entity type and tax situation. I hope that helped. Have a great day.